What's up investors, Sneers here. Most mutual funds underperform the market, more than 80% of them by some accounts. I addressed what this stat means for active investing in general in some other video which you can see in the card above me right now. In this video we will discover why mutual funds underperform the market, and by inverting those reasons we will see why we as individual investors have an edge on the market on the pros. To drive forward the points, I will use what Peter Lynch himself said in his book One Up on Wall Street on the matters. Peter Lynch is a legendary mutual fund investor, leading the Magellan Fund, which he managed to have more than 29% average annual returns. So who's better to understand the mutual fund's problems than Peter Lynch himself, a mutual fund manager that beat the odds and got 29% average annual returns. Guys, before we begin, I want to remind you that as always, I have more resources for the individual investor in the description below. And as always, if you can leave a like on this video, as this research takes a long time, and a like for this video helps me a lot with the YouTube algorithm, so it will be super appreciated. Thank you, and with that, let's go to the video. Mutual funds have structural problems that leads most of them to underperform the market. The rules around them and the incentive structures for the managers are leading most of them to mediocre results at best. We will name 4 most common reasons for that, and for each reason we will back it up with a quote from Peter Lynch himself. So let's get into it. First, we have to talk about rules and regulations forcing the fund manager to do certain actions. Even if the fund managers want to make a good investment or a good decision, usually the regulations and the rules inflicted on him by the companies themselves are leading him to underperform the market by not taking those actions. Let's examine that. First, there are the internal rules. The rules that the investment bank or the pension fund or whatever is it that controls the mutual fund inflict on the money manager himself. Let's discover what Peter Lynch himself said about it. Some bank trust departments simply won't allow the buying of stocks in any companies with unions. Others won't invest in non-growth industries or in specific industry groups. Now, Peter Lynch in the book goes on to describe more weird rules inflicted by the managers above the money managers in these mutual funds, and describe how these internal rules prevent the money manager from creating his own strategy that he can utilize, because these rules, these internal rules, prevent him from investing in good companies that he thinks are good. Next are regulations that are specific to mutual fund, and specifically a regulation called 75-510. Before we explain that, let's see what Peter Lynch says about it in the book. If it's not the bank or the mutual fund making up rules, then it's the SEC. For instance, the SEC says a mutual fund such as mine cannot own more than 10% of the shares in any given company, nor can we invest more than 5% of the fund asset in any given stock. So the 2 rules here that are most important is, first, you cannot hold more than 5% of the fund in any single stock, and second, you can't hold more than 10% in any company. So what does it mean? First and foremost, it forces any mutual fund to diversify their investments, and that's not always the best decision. Diversification have many reasons why it's bad for creating wealth, and I will go into that in a future video. But just to create some reasoning here, let's go into 2 main points. First, the fund can't focus on winners. If it finds a winner, it can only hold up until 5% of the fund in this winner. Even if it's sure this winner is the big winner and it wants to put more money into it, it just can't do that. And if we go to the Warren Buffett quote that I really like, he said, diversification may preserve wealth, but concentration builds wealth. And funds, mutual funds, according to the regulations, simply can't do that. The second issue is keeping track of your investments. If you hold up to 5% in any stock, it means you have to hold at least 20 stocks in any mutual fund. And 20 companies is very hard to keep track for a single person, which leads the management of the fund to have multiple people managing the companies, and no single people know everything they invest in into depth, and that leads to problems when managing the money. Peter Lynch himself famously said, know what you own and know why you own it. And when you hold so many companies, no single people can do that really good. Now to the second reason that mutual funds fail, they are playing it too safe. The structure of incentives for mutual funds are such that they have to perform at least well enough every quarter, because their customers that put their money in the fund can retract their money at any point. So if they will underperform massively on a single quarter, a lot of their customers will just take away their money. So they don't have to really perform well every quarter, but they need to perform well enough that their customers will not leave them. Let's see what Peter Lynch himself said about it. The fund manager most likely is looking for reasons not to buy exciting stocks. And another quote is, "There's an unwritten rule in Wall Street. You will never lose your job losing your client's money in IBM." What Peter Lynch referring here is that even if you lose money, putting your money on a really safe company like IBM was in the 90s, so the clients will not blame you, they will not retract your money. After all, it's all a marketing play here. You need to keep your customers in the mutual fund, and if you lose their money on a great stock, that's no harm. And he refers to that in the next quote as well. If IBM goes bad and you bought it, the client and the bosses will ask, "What's wrong with the damn IBM lately?" But if La Quinta Motor Inns goes bad, they will ask, "What's wrong with you?" And that's really important, because the incentive structure of the mutual fund leads you to play it as safe as possible, because you need to keep the customers in the fund. That's your number one priority. Not making them really good money, but keep them in the fund, because after all, the customers, through their fees to the fund, pay your salary. So you want to keep them in and not necessarily do risky moves or going to some exciting investments in the name of getting them more money on their investments. Which all leads us to the third reason, which is following trends. Mutual fund managers are following trends, not creating ones. They look for what is trendy right now in the market because of the incentives I already mentioned, and they invest in these companies alone. And let's see what Peter Lynch says about it. They don't buy Walmart when the stock sells for $4, and it's dinky store in a dinky little town in Arkansas, but soon to expand. They buy Walmart when there's an outlet in every large population center in America, 50 analysts following the company, and the chairman of Walmart is featured in a People's magazine as the eccentric billionaire who drives a pickup truck to work. By then, the stock sells for $40. So there you have it. If you mostly follow the market because of the incentive structure and everything like that, you will get at most the market results. And by the nature of it, you won't follow the market perfectly every time, so you will underperform the market, which leads us to the result that we saw, that more than 80% of the mutual funds underperform the market. To outperform the market, you have to do things differently than the market itself. So you have to follow, for example, Buffett's quote, "Be fearful when others are greedy and greedy when others are fearful." But if you, as a fund manager, by the structure of the fund, follow trends, you will always do what others doing, and you will never be greedy when others are fearful, and thus you will never outperform the market. The fourth and last reason we will talk today is size. Managing hundreds of millions or billions of dollars in some cases is very hard. Peter Lynch himself said about himself, "My biggest disadvantage is size. The bigger the equity fund, the harder it gets to outperform the competition." There are many reasons that being big is harder on you to outperform the market, and I will talk about it in a future video in depth. But just to give some reasoning here, the first one is that you have limited options. If you have so much money, you can't really invest in a small company worth $500 million because of the regulation we mentioned before, that you can't hold more than 10% of any company. And because for a $500 million, it means you can most invest $50 million, and $50 million for a fund managing $1 billion doesn't even worth the salary of one analyst. So it's out of the question of investing in these kind of companies. The second thing is that you are so big that you change the market yourself. If you hold so much money and you decide to go out of certain markets, or you decide to go out of certain big company, if your holding is so big, by selling the shares yourself, you will affect the price. So you need to dwindle down on the length of months sometimes. So guys, that's it for today. I hope you enjoyed this video and I hope it was helpful for you to understand why mutual funds underperform. If you like this kind of content, please consider subscribing to get more content for individual investors, and leave a like if you like this video because it helps me a lot with the YouTube algorithm. And with that said, I will see you in the next video. Bye bye.